The minimal criteria for digital transfers are government-issued documentation, a bank account, and a cell phone. The bare minimum for to transact Bitcoin is just access to the internet. Then there's the know your customer rule. Know your customer rule or know your client KYC processes. These processes are required for bank accounts and other financial products. What it implies is that banks are obligated by law to keep track of a client's identification before signing them up. Without identity, anybody can join the Bitcoin network. Theoretically, even an artificially intelligent entity may take part of the Bitcoin network. The other feature is privacy. The customer's bank account data is captured on the bank's dedicated servers. The confidentiality of a bank account is just as safe as the bank's servers and how well the user encrypts their data. If the bank systems are hacked, the individual's account will be hacked as well. In the case of Bitcoin's users can keep their transactions as personal as they like. Although all Bitcoin may be traced, it's hard to determine who actually owns the Bitcoin if it was acquired privately. When Bitcoin is acquired through a KYC market or know your customer market, the Bitcoin is linked to the account owner of the KYC swap. Transaction fees, card payments. The cost varies per card and is not fully reimbursed by the customer. Stores pay fees to payment systems, which are typically billed per transaction. This tax has the potential to raise the cost of products. Checks. Depending on your bank checks, it might cost anywhere from $1 to $30. Consider ACH transactions. If delivering to external accounts, ACH remittances can cost up to $3. Bank wire. Domestic electronic payments can be as expensive as $25. Global wire transfers can cost as much as $45. Bitcoin transactions costs are controlled by both miners and consumers. The cost can be anywhere from $0 to $50, but users have the option of deciding what they're prepared to spend. This establishes an open economy where if a user's charge is reduced, the process may not be completed. Transaction speed. With card payments, it's about 24 to 48 hours. With checks, 24 to 72 hours to clear. ACH transactions are about 24 to 48 hours. Wire happens within 24 hours, except with global based on the network traffic. But Bitcoin transactions might take anywhere from 15 minutes to about an hour. When you consider account seizures, governments can effectively monitor individuals' bank accounts and take the assets contained within them, using the KYC requirements. Governments or any other entities in power may have a difficult time hunting down and seizing Bitcoin when used discreetly. Banks on weekdays, traditional brick and mortar banks operate from 9 a.m. to 5 p.m. and they're off on the weekends. But when it comes to Bitcoin, it's a 24-hour, 7 days a week market. For whatever reason, banks maintain the power to withhold transactions. Banks also hold the right to put account freezes in place. Purchases made in strange areas or for peculiar things may be refused by your bank. But with the Bitcoin network, there's no intermediary. Bitcoin does not influence how Bitcoin is utilized in any way. Customers can utilize Bitcoin in any way they choose, but they may also have to follow rules of the geographical location or jurisdiction. A bank account's data is only as safe as the bank's database that houses client cards and client's details, assuming the customer uses standard internet security precautions, such as utilizing strong passwords and two-factor authentication. However, the Bitcoin system becomes safer as it grows. A Bitcoin owner's security level with their Bitcoin is entirely up to them. As a result, it is suggested that greater amounts of Bitcoin or any quantity meant to be retained for a significant period is stored in a cold storage. A cold storage is a hardware wallet. Essentially, a wallet that's not connected to the internet is considered a cold storage. How is Bitcoin? How's the blockchain used? Blocks on the Bitcoin's blockchain, as we now understand, manage data regarding financial transactions. But it does seem that that the blockchain can also be used to store data about other kinds of transactions. For instance, Walmart, Pfizer, Siemens, Unilever, and a slew of other corporations have indeed adopted blockchain technology. IBM, for example, has developed a blockchain for the food trust to track the path taken by food goods on their way to their customers. There's been countless epidemics of diseases and pandemics and hazardous compounds mistakenly injected into meals have occurred in the food industry. It's used to take a couple of weeks to figure out what was causing these epidemics or what was causing people to get ill from what they were consuming. Brands can now follow a culinary product's journey from its inception to every stop that it makes, and eventually to its distribution thanks to blockchain. If a food item is determined to be tainted, it can be traced back to its source through every stop. Not just that, but these businesses can see everything they've come into contact with, perhaps protecting the public by enabling the issue to be identified far earlier. This is just one instance of a blockchain in action, but there are many different ways to create a blockchain or to utilize a blockchain. Banking is perhaps the industry that stands to gain the most from incorporating blockchain into its corporate operations. Banking firms are only open 5 days per week during office hours. What this implies is that if you attempt to deposit a check at about 6 p.m. on Friday, you likely have to wait until Monday morning to see the cash in the bank, even though you initiate your deposit within office hours. It may take 1 to 3 business days for transactions to be verified due to the sheer amount of transactions that financial institutions must process using an antiquated system. Blockchain, on the other hand, is on and functional all the time. Customers see their transactions executed for as little as 10 minutes by adopting this or connecting to this technology or using it for banking, which is the time taken to upload a block to the blockchain, irrespective of festivals or the time of the day or the time of the week. Banks may now trade funds across firms more swiftly and safely thanks to blockchain technology. The settlement and clearance procedure in the stock exchange industry, for instance, can take up to 3 days or more if it's trading overseas, which means that the cash and shares are trapped during that time. Due to the fact that large sums are involved, even a few days in transit can result in considerable expenses and hazards for institutions. The potential savings, according to European banks, and it's range from $15 billion to $20 billion each year using blockchain. Blockchain-based software might actually save clients up to $16 billion in banking and insurance expenses every year. Blockchain is the foundation for cryptocurrencies such as Bitcoin, as we've already mentioned. The Federal Reserve is in charge of the US dollar. A customer's data and money system are essentially at the mercy of their banking institution within this main authority structure. If a user's bank gets corrupted, the customer's data is exposed. The worth of the client's cash may be jeopardized if their bank fails or if they live in a country with an uncertain government. A few of the banks that went bankrupt in 2008 were partly bailed out with taxpayer funds. These are the concerns that led to the creation and development of Bitcoin. Blockchain lets Bitcoin and other cryptocurrencies function with no need for centralized power by distributing their activities over a computer system. It not only lowers risk, but it also removes a lot of the transactions and processing costs. It can also provide a more strong currency with more uses and a larger network of individuals and institutions with whom to trade with, both locally and globally. For those in other nations with weak currencies or banking infrastructure, or people not having a state identity, utilizing cryptocurrency wallets for bank deposits or as a payment method is very important. Some states could be in the midst of a civil war, or their governments may lack the necessary infrastructures to offer identity or identity instruments. Residents of such countries may be unable to open savings or checking accounts or investment accounts, leaving them with no means of safely storing assets. In healthcare, healthcare professionals can use blockchains to maintain their patients' health records safe. If a health record is created and verified, this can be stored on the blockchain, giving patients confirmation and assurance that the confirmation cannot be altered. These private patient data might be encrypted and saved on the blockchain using a secret key or a private key, a seed phrase, or mnemonic. This secret key guarantees that very few people get access to their stash property records. If you've ever visited your area recorder's office, you understand how inefficient and time consuming the procedure of documenting property rights can be. A physical deed is still required to be presented to a government worker at the district's registering office, where this is manually put in the country's centralized database and public index. Ownership claims should be matched with the open index in the event of a legal dispute. This procedure is not only expensive and time consuming, but it also is prone to human mistakes, which with each error reducing the efficiency of ownership tracking. Screening documents and hunting down actual documents in a local registration office could be obsolete thanks to blockchain. Property owners may believe that their deeds are accurate and permanently documented if it is kept and validated on the blockchain. It could be hard to demonstrate ownership of the asset in war-torn countries or locations with no or little government banking systems. Private ownership dates could be set in a secure and transparent manner if a group of individuals residing in such a region is willing to use blockchain technology to secure it. Smart contract. A smart contract is a piece of computer code that can be included in the blockchain to help coordinate, validate, or negotiate terms. The community agrees to a set of requirements for smart contracts, for the smart contracts to be activated. The details of the deal are immediately implemented out once those circumstances are met. Let's say a prospective tenant wants to acquire a house using a smart contract or rent a house using a smart contract. When the client pays the security deposit, the owner offers to give the tenant the house's door code or the keys or the access to the premises. Both the renter and the owner would submit the sections of the agreement to the smart contract that will keep track of the door number and immediately swap it for the deposit on the lease's start date. The deposit is refunded if the owner fails to provide the door code by the tenancy date. This will reduce the charges and processes associated with using a registrar, third-party arbitrator, or attorney. When it comes to supply chains, traders can utilize the blockchains to track the origins of materials they acquire, similar to IBM Food Trust, together with typical labels like organic, local, and fair trade. It would allow businesses to authenticate the legitimacy of their goods. The food sector is fast using blockchain to monitor the route and food safety from the farm to consumer, according based on research. When it comes to voting, blockchain might be used to aid in the development of a contemporary system of voting. As demonstrated in the November 2018 midterm elections in West Virginia, voting using blockchain has the ability to eradicate malpractices and increase the turnout rate. Adopting blockchain in this manner can make tampering with votes almost, very difficult. The blockchain protocol will also ensure electoral openness by lowering the number of people required to run an election and giving authorities near instant results. There'd be no need for recounting. There would be no real concern that the poll would be tainted by fraud. Let's talk about the advantages and the disadvantages of blockchains. By eliminating human intervention from the authentication process, accuracy has been improved. Cost savings through obviating the need for third-party authentication it is more difficult to alter a decentralized system. The transactions are safe, confidential, and quick. Honest technology for inhabitants of states with insecure or weak governments. It creates a financial alternative and a mechanism to safeguard individual data. Bitcoin mining has a huge technological expense. Transactions per second are low. Record of use in illegal acts in the past. So let's take a closer look at the benefits of blockchain for firms now in the market. Advantages of blockchain accuracy. A system of thousands of servers approves transactions on the blockchain platform. This virtually eliminates human intervention in the authentication process, resulting in a low mistake and a more reliable record of data. Even though one of the computers on the network committed a mathematical error, what it will do, it will only affect one copy of the blockchain. To extend to the remainder of the blockchain, that error would have to be performed by at least 51% of the network's computers, which is nearly impossible in a vast and developing network like Bitcoin's. When it comes to cost reduction, customers usually pay a financial institution to authenticate a transaction, a registrar to certify a document, a preacher to marry them. The blockchain removes the necessity of a third-party authentication, as well as the fees that are associated with it. When businesses take card payments, for instance, they must pay a lower charge, such as like payment processing fees to payment processing companies handle the transactions. Bitcoin, on the other hand, has no middle party, and the fees are a lot much cheaper. When decentralization, blockchain doesn't save any of its data in one place. Rather, a system of computers or nodes spread out through the blockchain network. Each computer is Blockchain makes it harder to manipulate data by disseminating it across networks instead of holding it in one single centralized database. If a hacker, for instance, obtained a copy of the blockchain, just a single portion of the original would be vulnerable instead of the entire network. When it comes to centralized powers or centralized entities, the settlement of transactions can take many days. For instance, if you place a check on Friday evening, you will not see that money in the bank until Monday morning. But when you're using blockchain technology that operates 24 hours a day, 365 days a year, and it's open and transparent, this can happen in record time, in very quick time. Transactions can be performed in as little as 10 minutes, and after only a few hours, they are deemed secure. This is especially important for cross-border transactions, which, can take substantial amount of time due to time zone differences and the requirements that all parties verify payment processing. Several blockchain systems function as public databases. What this does is it allows anybody with an internet connection in any part of the world to access the network's transaction history. Even though users have access to transaction details, they do not have access to the identifying information about the people who are conducting transactions on that network. It's a frequent misconception that blockchain networks such as Bitcoin are private, but they're not. What is the case is, instead of their private details, a customer's unique code known as their public key is stored on the blockchain when they conduct public transactions. A person's identity is still connected to their blockchain address if they completed a Bitcoin buy, a Bitcoin swap, a Bitcoin sell on a platform that needs documentation. But a transaction, even when attached to an individual's name, does not divulge any individual's data. Blockchain technology must verify the legitimacy of a transaction after it has been published. A lot of the computers or the nodes on the blockchain scramble to verify that the purchase is accurate or the transaction is accurate. The transaction is then uploaded to the blockchain block once it has been verified by one of the nodes or a few of the nodes. Every block on the blockchain can have its distinctive hash as well as the hash of the previous block. The hash code of a block alters when the data on it has changed in any way. However, the hash code of the block after it does not, because of this disparity, changing data on the blockchain without notification is exceptionally difficult. Let's talk about transparency. The majority of blockchain are made up entirely of mainstream applications. This implies anybody with access to internet can look at the code. It allows auditors to check the safety of crypto, such as Bitcoin. It also implies that no actual authority exists over who manages Bitcoin's code, how it's modified, etc. What this means is that anybody can propose system modifications. Bitcoin can be upgraded if a large percentage of users concur that a new version of the code with the revamp is solid and valuable. And here's the most important part, is banking the unbanked. The capacity of everyone, irrespective of race, sex, or ethnic heritage, to use blockchain and Bitcoin is maybe its most significant feature. As World Bank, approximately 2 billion adults lack bank accounts or any other method of holding money or wealth. Almost everyone in this group probably lives in poor parts of the world or a cash-based economy. These individuals frequently earn small amounts of money that are paid in cash. They must then hide their actual currency in their homes or place of business, leaving them very vulnerable to theft or unwarranted violence. And Bitcoin's wallet's keys can be written down, memorized, kept on an inexpensive mobile phone, or even, written down on paper. These solutions are more likely to be hidden than a little pile of cash under a mattress for most people. Blockchains in the coming days and years are also exploring ways to store medical information, intellectual property, and a range of other legal contracts, in addition to being a unit of account for wealth storage. Here are the different disadvantages of blockchain. Whereas the blockchain has a lot of benefit, it also has a lot of drawbacks when it comes to acceptance. Today's hurdles to blockchain technology adoption aren't only technological. For the most part, the real obstacles are political and legal, not to mention the dozens of hours of specialized software architecture and back-end programming needed to incorporate blockchain into existing business systems. Some of the drawbacks include the technology costs. While blockchain can save clients money on transaction costs, it's not a cheap technology. Bitcoin's proof of work method, for instance, demands a tremendous amount of processing power to validate transactions. In the actual world, the power generated by the Bitcoin network's millions of computers is about equivalent to Denmark's yearly electricity consumption. Picture mining costs, excluding hardware costs, in upwards of $5,000 to $7,000 per coin, assuming 0.0 like 3 cents per kilowatt hour electricity cost. Despite the high expenses of Bitcoin mining, you see a lot of consumers continue to increase their electricity expenditures to confirm blockchain transaction. Why this is happening is because miners are compensated with a lot of Bitcoin for their time and effort when they add a block to the Bitcoin blockchain. Miners will need to be compensated or incentivized to validate transactions on blockchain that do not use crypto. Some answers to these problems are starting to emerge. Bitcoin mining farms, for instance, have indeed been established to utilize solar electricity, extra natural gas through fracking facilities, or wind farm energy. Bitcoin is an excellent example of blockchain's potential flaws. It requires around 10 minutes for Bitcoin's proof of work method to add a new block to the network. The blockchain network can only handle roughly 7 transactions per second at that rate. When you consider other cryptocurrencies like Ethereum, which outperforms Bitcoin, they're still constrained by blockchain. For perspective, the legacy Visa brand can generate 24,000 transactions per second. And over the years, people have been working on solutions to this particular problem. Some blockchain can handle over 30,000 transactions per second at this particular time. And you also have, unfortunately, rampant illegal activity. While blockchain performs secrecy, shields consumers from hacking, and maintains their confidentiality, it also provides for unlawful trading activities. An example is using the Tor browser. Users could visit websites without being tracked and make unlawful Bitcoin and other crypto transactions. Financial institutions must gather customer data when they open an account, also known as KYC, or Know Your Customer. They have to authenticate each customer's identity, and they also have to check that consumers do not feature on any set of identified or alleged terrorist groups, according to existing US legislation. This platform has both advantages and disadvantages. It enables anyone to monitor financial records, but it also makes it easier for fraudsters to transact. Many people have claimed that positive uses of, a lot of the negative uses, a majority of unlawful behavior is still carried out on this network, unfortunately. Many people in the crypto community are worried regarding government oversight of cryptocurrency. Governments might conceivably make it unlawful to hold crypto or engage in in using crypto or exchanging it or trading it, even though ending something such as Bitcoin is becoming incredibly difficult as its distributed network size continues to grow. As big as corporations like PayPal start to have adopted the use of crypto on their platforms, the issue has, you're starting to see mainstream adoption, with cities like Miami issuing Miami Coin. Blockchain, which was the first presented as a research project in 1991, is now in its late 20s. Blockchain, as with most millennials its age, has gotten a lot of press in the past 2 decades, with companies all across the world guessing on what the technology can do and where it will go in the future, with several real-world applications for the tech now being executed and studied. Blockchain, at the age of 27, is already gaining a reputation for itself, thanks largely to the Bitcoin and cryptocurrency. Blockchain, a catchphrase on the lips of every entrepreneur in the country, promises to make corporate and government processes more precise, effective, safe, by eliminating middle brokers. It's no longer an issue if legacy organizations will adopt blockchain. It's a question of when, as we approach the third decade of blockchain.